Oh, don't do that. You'll put me out of business.
If you look at the matrix for any day and find the highest number for support and the highest number for resistance, what you really identified is a high probability of what the trading range is going to be for the day.
Ah, you've already put me by 1 hour. But that's good. That's exactly correct. Because I'm telling you how I use it myself. And I know that we will see examples of it, especially in the more volatile markets like bonds, S&P, and soybeans. I'm showing you examples first on not gentle, because the wheat is a phenomenal trending market. And believe me, if you can't make money with the wheat, you really shouldn't be trading. And that's my opinion. This is one of the easiest markets if you have any concept about market geometry or trading 2 time periods together. Yes. Trading 2 time periods together. And I'm showing the wheat because it's a gentler type of market, and also the margins on wheat are certainly lower than S&P or bonds, etc., for that very specific reason. It enables the people who are new to commodity trading to get their feet wet without risking $100,000. You know, there are limitations to the wheat because you can't get directly to the floor, and it's still got to be the old-fashioned runner, and so on and so forth. I happen to love trading. My main trading is, number 1 is the bonds, and number 2 is the wheat. And of course, it aggravates me as anything that my order cannot be signaled straight into the pit, as in the bonds, and immediately you're filled. In the wheat, you still run. A little guy takes a piece of paper, the runner, and runs to the floor. But that's the cost of doing business. But what you say is correct, that in congested areas, even taking this one step further, not only is Sean right that the 2 highest numbers, whichever is hit first, usually bounces to the second, defines the trading range for the day. Just as importantly, and I didn't want to talk about this, but this came up, so we will mention it, what you're going to find is that the opening price, 70% of the time, is within 10% of the bottom or the top of the trading range. Does everybody understand what I'm saying? What you're going to find is that the opening price, let's look at this example here. We will go and we'll do this day, because this was a very interesting day from a zone analysis point of view, because this resistance band failed. Did we have some kind of information, as far as we are concerned, that this was possible happening? And the answer is, let us go. I'm jumping ahead a little bit. We're going to systems, use, let's say the Gann swing high-low. Keep it simple. Does it tell you something here? Look at the 45 minutes high-low indicator that put you into the trade on this trading day. And look how it followed the trade up all the way from here, where you entered the trade. If you're waiting for the close, you could have done it here. Intraday, of course, you could do it a little bit lower. And let me tell you that this was last week, by the way. I'm finding a little tricky to read this, but in the 342 area, and started to take profit around the 345, 340, about 4 cents you made. It's $200 a contract. It's a living. This is a very simple thing. This is not, look at the 45 minutes coming down here. Did you have any contra action? Was there any reason to take any contra action here? Now, if you combine this with the dynamic trio, and we scrunch these bars in a little bit, Now that's a reasonable move in 45-minute basis, just using one indicator from the Fibonacci trader. That's it. We haven't even talked of zone analysis, support bands, resistance bands. When this had a close below, you had your sell here. Let me run this down a little bit. Here is your close all the way down, close above. You can work it out for yourself. But you were never in a doubt as what was going on. Is the Gann 45-minute swing chart, this is what we're doing with the daily, is it red, is it dashed? Of course, the trend is down. Is the slope down? Yes, the slope is also down. Can you be anything but short in this game? No, sir. Not if you look at the markets the way I look at it. It's impossible. Anyway, back to our friend, the zones. Get rid of some of this. Okay, we just back with the pure zones. Let us go to the day that had a reasonable move here. We can do it another way, save a bit of time. Okay. We're going to look at the day that was a reasonable move up, and perhaps I should thicken up the bars a little bit so you can see a little better. Okay. We can see that on this day, which is the 14th of November, not a million years ago, we closed in zone number 2. And you can see both areas where we closed. Closing in zone number 2 here. And on the matrix, you can also see we closed in zone number 2. The next day, we have the open, and we opened in zone number 4. So we closed in zone 2, opened in zone 4. So the combination is a 2-4 pattern. And what do you see with the 2-4 pattern? Number one, of course, if it opens in zone 4 by implication, zone 4 is reached 100% of the time. What are the two numbers that I'm interested in? Wow, I have a 73 and a 74. Those are not to be ignored, folks. Those numbers are not to be ignored. Do I care which is reached first? Of course not. Of course not. Why? Because I can't control it. I can only react to the market. I can't control the market. But because I have here a situation that says, hey, Kraus, zone number 5, which is up here, is going to be reached 74% of the time. And zone number 3 is going to be reached, 74 and 73, roughly equal. I know that if it goes to zone number 3 first, I have 55% support. But because I know that zone number 5 is reached 74% of the time, the probability exists that this may be a reasonable area to buy in, because the support is well over 50%. And I mentioned to you, I always look at the zone preceding the high probability. So we have a 55 and 56. So when I combine 2 and 3 together, there seems to be reasonable support. They're not fantastic, but reasonable. But now when I look at today's close, 60% of the time, guys, the close is going to be higher than the open for that day and for the next day. I mean, for goodness sake, what more do you want from one indicator? I mean, you know, it has taken me years. If you would have shown this to me, I was salivating when I saw this stuff coming up. And after 3 months, I still had problem believing it. But you play with it. My advice to you is don't believe anything I tell you. It's your money. Check me out. Check out the system. When you feel comfortable with it, That's when you start putting money in your line. Don't dive in on Monday morning and say, hey, Kraus said so. Forget it. That's BS. It's your money, it's your brains, and it's your concepts. I can only lay the foundation, but you are the guys who have to actually build the houses. And the houses is your money, your ideas, your own subconscious, your approach to the market. And therefore, anything I tell you, I beg of you, check it out, please. Okay? I just... The slope, of course, Sean. Of course. But again, you're 1 year ahead of the game. Right. So what does it tell us? Not only is it that day, the percentage of closes, there's a 60% shot that is going to close higher, but there's a 60% shot it's going to close higher even the next day. And there's 56% shot it's going to close the third day, and the fourth day is again 60%. This is pretty good odds as far as I'm concerned looking into the future. And therefore I am absolutely raving to buy the market at the first possible opportunity. Is there anything, and why? Because I know, hey, if the market goes down first, look where zone number 2 is. Is my little support band is there. So I am really hoping, hey, if the market goes down to zone number 3, where 73% of the chance of the time I have a potential buy, and I have a 74% to get to zone 5, this is a gift from the gods. The market is saying, hey, Kraus, it's time to put some money on the table. Sorry?
You're not suggesting that we assume a long position is downtrend.
I'm not suggesting anything. I'm only trying to demo to you the validity of the zone concept if you do intraday trading on commodities in the United States. The trading plan is going to kick in a moment. I prephrased that. The two have to go together. You have to do a trading plan. Also, I told you that a small percentage of the time, the contra-trend trade is going to be your what? Your home run. When do you think the contra-trend trade stands a chance of being a home run? Now you have to start thinking, guys. I can only lay the groundwork. The thinking is up to you. I will just guide you in a gentle way. In a gentle way. Okay. The next bar tells me nothing. There's zero information. It's a small Zippo bar, meaningless inside bar, but no big highs, no big lows. Patience, patience. Hello? If you were waiting for zone number 3 to be hit, excuse me, yes. Wait a second. On bar number 2, was zone number 3 reached? I can't see from here so well, as I'm reading over. The answer is yes. So already the promise was starting to be kept. Half the equation was there. Now we have to say, okay, is it going to reach zone number 5? And my goodness, it certainly did. On the very next bar, not only did it reach zone 5, in fact, that 45-minute bar closed in zone number 6. And you can see there's the little ball which shows the last price of that particular day. In other words, this is a potential reversal to the upside, okay, on this particular day on 45-minute basis. Did we think this was a possible buy with our other tools? So if you go back into systems, use, just let's use the simple one, we can say dynamic trio, and there was an attempt to close above it. No, this is, of course, high-low activator. Closed above the high-low activator, potential trend change. Let's go into the high-low activator. Excuse me, dynamic trio. Unfortunately, this is the same color, so we'll just change this. Dynamic trio own, edit. I will make the own period both white. You can see that the dynamic trio hangs back a little bit from the market. You can see on this time period here, these 3 45-minute bars gave you a dead level area that says, hey, if prices take this out, go for it. Where do you think this, well, I don't want to get into that. But when it closes above the dynamic trio and above the high-low activator, you better be long, folks. Yes, I know. The trend is still down. And Sean, is the swing up? Yeah. Exactly. Read the back section of the book, and what tells you? This is the, huh?
The nothing bar you described was when the slope would have changed.
Exactly. Exactly. Okay. Let's get rid of that, otherwise confusion will reign.
Does the 62% resistance bother you at this point, Robert?
No, not really. Not for intraday trading. When you have 70 percenters and 60 percenters on the closes, if you work with this for a while, Sean, what you're going to find that those are the days when the 38, 62, and the 100% fails. This defines the early potential of the move, intraday basis.
So the momentum is so strong here, you don't worry about the 62.
It just blows through it. And this is how trends change. Trends normally change from down to up is when either some major news hits the market, or if you're trading bonds or crash currencies, government announcement, interest rates, etc., etc., or some news or something has happened in El Nino, rumors hit the market, it's raining on LaSalle Street, and so on and so forth. We don't care what those fundamental information is. We want to be able to tell via our 45-minute bars, and I don't suggest going much lower than 45 minutes on the wheat, when the potential exists for a true trend reversal. So if you really are a professional trader, which you're trading the daily bars and the intraday bars, you enter via the intraday. And if the close confirms the direction, then you take the daily trade also. So it gives you an opportunity, utilizing zonal information, to enter a potential valid potential with a capital P. No guarantees, folks. This may be the trend reversal that sets up a 4 5-day move, a 3-day move, and sometimes a 15-week move. And this is how it happens. It starts in this basis, because if you realize anything what we talked about, the time frame implications, what's going to change the trend? What changes first? The 45-minute trend must change before the daily, and the daily will change before the weekly. This is one of the reasons why I trade the lower time periods, because it enables me to feel the market. Even if you're not going to take the signal, when this kind of occurrence occurs, you can anticipate, hey, the daily may also change. And then you enter the market via the daily. There's no written rule in the world, you must trade the 45-minute beans, S&P, bonds, whatever. Intraday, of course not. But the information is there that the potential exists for a true trend reversal to begin on the next time period basis, because this is 45-minute, daily, weekly. Okay. Let's get rid of the other stuff. We will bring it back again, how to tie it together. So now this is bar number 3, and tremendous Once again, bar number 4 again closes in zone number 6. You can see now we go to zone number 6, and it's closed in zone number 6. This is reached only 29% of the time. So we know the information that this is not a normal everyday occurrence. And what is trend reversal? Trend reversals are not normal everyday occurrences, guys. We have to think a little bit. So the next step that tells you, firstly, of course, the zone meter tells you where the price is, so on and so forth. But we also note, hey, this zone 6 is resistance 62% of the time. Even if we close here in zone number 6, did the day close prediction fulfill itself? The answer is yes. Are we closing above the open? By golly, you sure we are. So we go to the last bar, and wow, new high on the day on the last bar, very nice. We're closing above the high of the previous 2 bars, or almost, certainly above the 2 previous closes, and we're closing in zone number 6. And we know that the forecast is tomorrow's potential close is also 60% higher, 60% of the time, than today's open, this day. And at that moment, we'll take a lunch break because I'm told the food's waiting. Okay.
Can you just punch us up, Chris? Just set where you want to be before we come up to.
Don't button. Okay.
Where you want to be?
That's as good as it's going to get.
Okay. Let us get. We're going to go back down to black, and then we'll cue you, and you can start.
Huh?
We're just going to go back down to black, and then we'll run the tape, and then you're ready.
Okay. Okay, we're going to talk a little bit about a concept that's being handled, and we will switch over to the computer to show different time periods and different applications of the tool that's already in the Fibonacci trader, masquerading or hiding under the name of volatility stop. And what you're going to see, and I will show you what the calculation is and how to do it, but I'll just run through very quickly. Example here, we started with the 45 minutes on the wheat. We will also show you some US bonds, 50-minute charts to see how this works. In the beginning, you may have forgotten, I already showed you a daily chart on the soybeans. This I call a directional volatility, which is not necessarily a tool that I use to enter or exit the market. I utilize this for direction. There are some computer programs that have this on, but the difference is that you need to have a computer program that has the next time period or multiple time frame available. Some people believe, and if you check it out, you'll see that this is a mistaken belief, that if you have 5 45-minute bars to the trading day, which is what we have here, if you put on a 15-period moving average, is equal to a 3-day volatility direction. Not so. Check it out, you'll see. You need the actual activity of the next time period up. This is fortunately one of the benefits of having a multiple time frame program, and I think it's only a matter of time before other computer programs will generate this type of activity, but it's not as easy as it looks on real-time programs. End of day, yes. Real-time, not so easy. Okay, I'll just run through this very quickly because I know some people have to leave. The actual calculation that I use, and I'll do it on the computer when I've run through this 1 years of charts, it's 3-day or 3-period, next time period, i.e. if you're looking at the 45 minutes, then it's got to be the daily, which is next time period on the computer. And the only two ratios that I look at is 1.618 or 1.382. And you can check this out yourself just by eyeballing it. The accuracy does differ from commodity to commodity, time period to time period, but you only have to look at two. It's always 3. This is constant. I don't change the 3-day business. I do change from 1.618, 1.382, but the strange and interesting and the beautiful phenomena is that once you found the correct one, it stays at that ratio for years and years and years. Now and then, every few years, you should check it. I check it every 6 months, but it's quite amazing how the ratio stays constant for direction. And the strength and the beauty of this is it is so easy to see and so visual that people who are mathematically inclined will miss the maths. People who are visually inclined like myself, all I know is if I'm below this line, I should be looking to sell. If I'm above the line, I should be looking to buy. And that's the way I want it. Let me just run through this. This, by the way, these charts are in the back of the book in color. These are the only colored charts you got. Brought to you at great expense, folks, because I thought it was so important to see this in color rather than just black and white. Okay, we look at chart number 1 on the weekly, which begins. These are all back to front, excuse me. 2, 3. Still on the other way, the way the printer prints it out. Okay. We start with the early January. You can see there is only 2 colored lines that we're interested in for the moment. Forget about the other stuff. You can look at it very carefully when you get home. The other lines on here are the high-low activator, next period, which is in blue. One of the blessings of this program, by the way, it's color coordinated. So when it's a blue step of the next time period drawing down, it also happens to be blue on the actual name on the left-hand side. All we want to look at the moment is what would be happening if you were selling below the daily volatility direction, or if you would be buying when it went above it. In other words, is the direction correct for us to take action with in a 12-month period under examination? Bless you, you sneezed on it. Which there is an old Yiddish folklore that if somebody sneezes whilst you're making a statement, you must be telling the truth. But never mind, just check it out anyway. Okay. This indicator works exactly the same way as all my other indicators. As this is the next time period up, from the 45 minutes is the chart or the bars that we're actually trading. But it is the next time period that provides us with the volatility direction. So before this line actually comes up above us over there for the first time, which I've circled, we need a daily close. This thing will haunt me till my grave, I'm telling you. I'll never use this bloody thing again. We need a daily close below the sell point here. In other words, what it is saying is this line here from this point kept you with the direction, and even though this went below it and this went below it, this was not on daily basis. In other words, this was an intraday activity of the 45-minute bars. The direction will only change by flipping to the other side is when you have a close of the day, and that's why I told you that my way of looking at the market, that the closing price of the day is the most important price. And the opening is the second most important price. Of course, the high and the low, etc., we've been talking about, do have their day in the sun, and there are energy points. But the close, for me, is the number one as far as my indicator measurements are concerned. So the moment I have a close below, and you can call it a sell stop, but I call it sell directional, that's the moment that this point comes up above and follows the market all the way down. And you can see even on intraday basis, we only have one close above this line until there is a daily close of which once again the support comes in and the uptrend begins. So what is this telling you? What it is telling you is, and I'll show you a couple of the other bits and pieces that are with it, is that the moment this flips and it goes below it on daily basis, and this flips and you have this point above it, from this moment onwards, all the way down until it flips back again to the other side, it may be advisable and more profitable to look for trades in the direction that the volatility is pointing you. I repeat that. It may be advisable to look for trades in the direction that the volatility is pointing you. And when I finish these few charts, I will switch on the computer and I will show you exactly where to alter to get these two numbers, 3 periods and 1.618 or 1.382. You can see on this chart here, which is also on yours, the volatility stop was 1.618. So you already know that for the wheat, 3 periods, 1.618, that's the number, and that's it. And we will look at them others, which are the correct numbers to utilize. Besides this, you don't have to be a real genius to see that the high-low activator of the daily is also running down. And what did we say about that? It's a completely different type of measurement. In other words, these two directional or trend indicators, if you like, are measured in a completely different way. That they are perfectly in tandem from this time, roughly before this actually closes above, is somewhere over there. So during this period, as long as the prices are below these steps and the steps are running down and the volatility direction is also down, because this volatility, it is actually based on volatility. It may be nice to take note of this fact and handle it accordingly and stay on the short side of the market. Now, from this moment, this covers January to about halfway through Feb, and then the charts carries on, And looky, looky. Who says there are no more trends in this business? Really? This runs from the 18th of, actually it's a bit earlier, but this chart runs from the 18th of Feb to the end of March. At no time was the directional volatility line threatened, cheated, giving you more false information. Beautiful. And this in real time, by the way, folks, updates tick by tick. This is not an end of day business. If you have real, yes, you can use it end of day, or you can even put the 45-minute prices in manually. That's what I used to do before I had a real-time program. And before that, I used to do it by hand. Drove me nuts. But this gives you a little indication. So far as we are concerned, not even an intraday close below this line from the 18th of Feb to the end of March. 6-week period, nothing to do. And once you learn how to work with this, you can say, hey, I'm only going to buy. And once you have simple money management techniques, or you pick up one of my ideas, and you plug in here the daily high-low activator, I'm going to stay with this trade till I have a close below it. Until then, I don't care. Let it go. Let the market do its own thing. It becomes trend following in the real nature of the word, the real meaning of the word. This trend, by the way, carried on onto the next chart without giving a false signal to the end of April, folks. So very nearly 3 months, very close to 3 months, a trend run. 12 trading weeks. Check it out. Does this only happen once every 5 years? No, sir. We'll check some more stuff, you'll see. And once it goes below it, look at this point here. Roughly in the middle. Once it goes below it, you get another selling opportunity. Where does it go to? It goes to, does it even have one daily close above it? No, sir. When we come up to here, does it have one daily close above it? No, sir. It holds like glue. Please believe me. This is the reason why I never shared this indicator before. And when this trend run down begins, you have one false signal, and we'll count how many false ones we had during the year. This is the first one. That if you have a mechanical plan, you have a daily close above it, and 1, 2, 3 days later, surprise, surprise, there's the magic 3 again, you have a daily close below the red line, and then it kept you short below. Once again, look at the high-low activator daily steps. Pattern recognition, folks. Is this a reasonably simple idea that if the daily high-low activator in step formation is below the daily directional volatility line, perhaps we should only sell? Same thing occurs here. All the way down until this turns up and we have a daily close above it. But this period, which was like a month and a half, again nice trading opportunities to the short side. That takes us into July. And we were told, hey, wheat was very tough trading this year. Really? Okay. Maybe your indicators, yes, but my indicators, we made a living. Look at this from July, when it clicks in July 14th area. Look at this. Look at this. Look at this. Look at this. Real time. And that's always projected. This is not hindsight, guys. That line is there during that trading day, minute by minute. This does not crop up the next day. This is real-time line. Okay? What were the greatest buying opportunities on this particular trend run? Once again, that lasted from mid-July on this chart to August 20th. Wherever the arrows are, the Chinese have a brilliant saying, which is danger equals opportunity. What was the least riskiest buys in this trend run up? Not up here. The least riskiest was over there. Because if you're a trader, you understand that the lower you buy, the quicker you're going to be proved wrong if it's a wrong move. So your stop can be much closer than if you bought it way up here. If you were wrong, where is your close? Your close below this is maybe 3 cents or 2 cents or half a cent below that line. You're out. But if you're right and the line holds and you have, those of you who are using Genie stuff, some support there from the heavens, then you know, hey, this is a potential buy signal with very limited risk. Because if you're buying that close to the line, you only need a 2 or 3 or 4 tick lower close, you're out. So your risk was small. But if you win, the price moves from about 345 up to about 375, 380 area on that one little move. Look at the high-low activator of the 45 minutes once it clicks in from here, and it's red, 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 red. The sell stop holds solid all the way up here. And I'll show you dozens of these kind of trades if you're only trading beans, bonds, and wheat. Not once every 5 years or once a year. These 4, 5, 6 trading opportunities, and what do you think this is? This is when the markets are non-random. Once again, we come back to the same thing, because this volatility direction is not the same type of measurement as the high-low activator. The high-low activator is just 3-period moving average. The volatility activator actually takes note of the volatility of the market. Yes, time is not involved except how long it takes to create the movement. Okay, let's go to the next page. From there, August keeps you again in the move. Again an opportunity, again an opportunity. Here, from this moment onwards, excuse me, this one, our blue guy flips above us. That's a reasonable move. The wheat here went from 385 roughly to about 350, 35-cent move. 35 times 50, how much money? Per contract. What's the margin on wheat? What's the margin on wheat? Roughly. You're trading wheat. What's the margin? $1,000. 150% on your money in 2 weeks on the margin. Go buy a program that gives you 150% on margin. $3,000. Here, you made it in 4 days. This is not rocket science, guys. This is already on your machine. It's on your machine. I just give you the numbers and that's it. Check it out for yourself. Yes, sir.
Is there any significance, for example, with the red line when it turns down? Does it make you nervous thinking, well, something's going to happen here? Or do you just say, till the color changes, I stick with it?
Firstly, the word nervous is not in my dictionary. I have jettisoned this word about 12 years ago. What made me nervous is when I didn't know where to put my stop and I didn't know the reason why. When those two things started dissipating, my nervousness dissipated in direct ratio. And I'm not kidding. I'm not being facetious. It's true. Okay. The question was, I presume, is there anything to worry about if this volatility line here comes back downwards? Have a look carefully at what you're saying. Look at this chart. When the volatility line reaches a bottom, look upwards. When the volatility reaches a down V, look upwards. Is that the top of the market, folks? This is what volatility does. We're not looking at price. We're looking at volatility. When you have a down market, and that's an up move, like a little hat, look downwards to the tick, the low of that move before there is an isolated low of the daily, because this day is lower than this day and this day. Is this something you can trade by? No, but it's something that I watch. It's called pattern recognition. And once you work with these things, you will find that it has something to say. It's the same old thing, the elephant footprints in the sand. If you read them, the signs are there. And that's one of the signs. Look up from here. Is that an isolated low when you have a high on the volatility? Yes, this is another way. This is an extra benefit from the tool. But this is not something that I'm saying you must watch, this is important. All I'm saying is prove the tool out to yourself. If you like it and it has meaning for you, then you will see that if you're below this line, it's more advantageous to sell than to buy. That's all I'm saying. And if you are a real professional trader, you will see this line itself will pay and must pay whatever you paid for this workshop. And if I charge you 10 times as much, and I kid you not, this line would be worth the money. And if you don't realize it, I am sorry, I apologize. Okay. I'm going to do that on the ratio. I will do that on the computer in a few minutes. But it's a 3-period, and a 3-period it looks at, and it's 1.618 to 1.382 of the past 3 periods range. That's what volatility does. I don't want to go into it because it will take a lot of maths to explain this concept. Okay, it goes up again, and here we go once again. This is, we were coming into just before the workshop finished. And guess who was short? Whoops, from this day. I have definitely crossed stars with this thing. Okay. Guess who was short from here to the close of business here? Was there anything for me to do besides selling? Do you have to utilize the 45 minutes? No. You have your encapsulation. Each of those little boxes are the daily bars. Did you have one daily close here above the daily high-low activator after you entered the trade below? What happened this day? You closed below the daily directional and below the daily high-low activator. That's why this came up for the first time. If you sold it here and you bought it back here, you didn't make a fortune, but it was 345 to 365. That's 20 cents times 50. That's $1,000 a contract. You trade a 6 lot, you made $6,000 bucks. That's a living.
You're trading end of day and you're using daily bars. Would you use hold period for that to keep it on daily?
Stanley, I will answer this question later, okay, because there are some other implications involved. If you're trading daily bars, you have to start looking at the 3rd time period, which is the weekly trend, okay? If you're trading at the end of day, you're becoming a different ball game. And I suggest that you start looking at it in this way. I believe that you have real-time stuff. Start looking at it in this way and then ease yourself off into that. But you can, in fact, have those concepts, but this is another 35-minute explanation how to integrate this with the weekly balance point steps or the weekly high-low activator, which also does the job. Okay. You can see the tools I'm using here. High-low activator 45 minutes, high-low activator daily, and directional volatility. These are all on your programs. There's no add-ons, schmad-ons, etc. This was a full 12 months of trading the 45 minutes. There was one false signal for a 3-day period during the 12 months. Take it home, check it out. Next, let's look at this on the bonds. $50-minute bond chart from September. 2, 1, 2, 3. Okay, here we go. June. Second half of this year, up to date. I've kept this very simple on purpose. You can see here that when the prices move over this particular indicator, and this is 50 minutes daily, weekly is the plan. Therefore, it is the daily, I repeat, once again, the daily directional volatility that's needed. And you can see this chart is once again in your setup. What's the number? 1.382. Again, 3 periods of the next period, i.e. the daily, because we're looking at 50-minute bars. Look at the daily high-low activator. The moment what happened, it turned up here. Bingo. Closes above. In other words, the high-low activator of the daily is riding, in this case, in tandem with the directional volatility. The directional volatility kept you in this trend all the way up from the 111.5 area to the 115 area. Nice move, $3,500 per car. There was only one day that you had a problem, was this day here, when there was a down and an up move. But even if you were blown out the water, you still made a profit on this. And then you had the way to get back into the market. Remember, put emphasis in the direction of the directional volatility line. And if you want to be really safe, only take trades in that direction. Because look what happened with the contra trend moves. Where did the contra trend moves? What was the best single buying opportunity here? This one. This one. Because if you were wrong, you knew very quickly for very small losses that you were wrong. This is the way trading markets work. Look carefully. We're looking at 45-minute bars, folks. Look directly above. Can be 1 or 2 bars before, 1 or 2 45-minute bars thereafter. But if we look, and here is a guy. Da-da. Was that the high of the move, folks? It's not dead on, but another spike. Go through. See what happens when the volatility gives a low, how close it is to the upper part. It is an interesting tool. It's definitely worth investigating. Sean, believe me, it's worth investigating. Okay. We go from June Now we go to from August down to September. Were there some confusing areas? Yes. This was a short-lived rally. But once the short-lived rally was over, this is what I often find, is that in a short-lived rally, the second change or getting over, this was number one, and this is number two. This number two often has real value. And it seems as though market seems to fake everybody out for whatever the reason. The weak hands throw in, and then the buying scooped up, comes in again, and we have a very nice little trend run. The market does tend to work. When you do look at this backtrack over 5 or 10 year periods, you will see certain patterns keep repeating again and again and again. And you have to become aware of it. Which were the really nice buy again when it came near here. And after that, there was no more buying opportunities. If you look at this low, that's where it is. You look at this low, that's where this is. Another pattern which you're going to see, how do I use this for even more information for direction? When I have rising valleys, we talked about this, not on price, but when you have rising valleys, as far as directional volatility is concerned, it is an indication of higher prices to come. It does not mean that tomorrow morning you're going to have a 200-point rise, but it does give you an indication that even the volatility has been tested on 50-minute basis. Remember, we're talking at 50-minute basis, real internal market mechanics. I could talk for 5 weeks about the bond market and the intricacies of it. But the reality is that you may be speculating in the bond market, but there are people that are trading it with real reason besides speculation. Banks, hedgers, they lock in their interest rates and so on. Yes, Sean.
Just an observation, Robert. As you point out, when the spike in volatility is down, it coincides with some sort of a high in the market. On both of these last two charts, when it got to the top, we reached a new high and there was no spike down in the volatility. It might be a sign that the market's about to turn.
Pattern recognition.
Or divergence.
Well, I don't even like to talk in terms. I'm trying to keep it, what you are correct. But there is definitely a rhythm to this that once you start following it, there are certain basic patterns that keep repeating. We've only talked about 2 of them. One of them was, hey, if you're above it, you should be looking to buy, especially if the daily high-low activator is above the directional volatility line and it's stepping upwards. And this brings us up to date. Once again, note the spikes, etc. But basically, I use it in a very simple way, not to overanalyze. I'm above here, I'm looking to buy. I'm below here, I'm looking to sell. That's why I place more emphasis and more contracts in the direction. I use it as a money management tool and as a directional tool. Okay, let's go to the computer, because I know some people have to run out. We change, and how do we change the volatility? Okay. I just want to put a few more bars onto the screen.
Could we somehow have the menu bar up there? Is there some way to get the menu bar?
Yes. Can we bring that down or make this a bit smaller, please? Otherwise, it's difficult for them to follow. Yeah, the top is more important than the bottom.
Maybe if you go to size.
Go size, vertical size.
Okay, can everybody?
Make the screen larger?
Huh?
That help with the screen larger?
Yeah, I can't. I know vertical it doesn't.
Another genius invention. Okay.
There's another menu bar.
Which one? This one? You mean on the left?
Can't
We
see
don't
on the
need it.
screen.
Huh?
Can't see it on the screen.
Don't worry about it. The important ones you can see. Okay? We go into indicators. And from indicators, you go down to the volatility stop. That's the volatility stop here. Okay? At the moment, it is set for the recommended number by various programs or books that are out there. If you want to make your own indicator out of it, is what I suggest, is you click on the volatility stop and you click on the edit at the bottom. Okay? Up comes the edit window and we will give it a name. Let's call it vol. Keep it simple. Let's make it capitals because this is not so easy to see. VOL. Directional, DIR. Okay? So that's what we're going to call it, volatility directional. But you can call it whatever you like. The first line says own period. And you can write this down if you like. When you click on own period once, it automatically, actually twice, excuse me, it brings up the next time period or the highest time period if you click on it again. But you can see it change from O to N. So that's step number one. Step number two, it says length or value is 7. We don't want 7. What we want is 3. And the constant value is 2.9. We don't want 2.9. We want 1.618 or 1.382. And we can see from the wheat, what I told you, is the constant here was 1.618. So we just type in there 1.618. If you don't want to bother, you can put 1.62, just as close. And this is adjustable. Wait for close, yes or no. My suggestion is for all your experiments, at the moment, put on yes. Because if you put no, it will act just with a close below the 45 minutes. It makes it much faster. Is that clear? Number of ticks at the moment, I've left it at 1. If you want to be a little more safe or a little more conservative, excuse me, it's a better word, you can change that to 2. And that is all you have to do. Now, if you want to have the long stop as red, I just happen to like it in blue. And I like to have the short stop in red. I may prefer purple. Now you have defined the name, you define the time period, you define the length, the constant, you're waiting for the close, yes or no, we left it as yes, by 2 ticks. In other words, it has to be a daily close above the daily, not intraday, that will define the flip from the long side to the short side, so the opposite color can come up. And now you say save as new, because you've just created a new indicator, but within the perimeters that are allowed in the program. In other words, you can't create, I don't have the facility. Somebody asked me, can you make up your own indicators? And the answer is no. But you can adjust and alter and change the names, the colors, whatever, and the calculations of any indicator already in the program, which there are, I believe, 36 standard ones and 15 proprietary ones. So if 50 indicators is not enough for you, that's life. I can't help it. All you do is you press Save as New, and it says, do you want to configure as a new, just in case you change your mind, and you say, OK. And so now, when you look, there is a new indicator just above the one you were working on, volatility direction, which is what we created. And you can see the volatility stop that we were working on. I will just highlight it. The original indicator has stayed intact. This has not been changed. And it's still there for you to experiment with and create different numbers, put in the highest time period if you like, and so on and so forth. So if you go now to the volatility direction and you add it and you exit, it should be there. I didn't change one thing. Let me get rid of the zones because it's confusing. I'll just put do not show. The only thing, this comes up normally in dot formation. The only thing that you have to add, and you can just edit it on screen, is draw type. And at the moment it says none. You click on line, so you want line formation. And you can say set for all. That means you don't have to define it for any of the other lines. You have 2, 10, 20 lines on screen. Set for all does the lot. You can see this is the calculation we worked out. Next period, next time period up. The constant was, the length was 3, number of days. Constant value was 1.618. We're waiting for the close by 2 ticks. Exit, and there we are. You have just done now. The bars are a little too thick, so we can see it clearer at 1 pixel. And if you want to see, this is what happens. From this moment onwards, when you have a daily close, as I'm showing you here, below the directional volatility line, the blue line comes up and follows you all the way down. And if you want to, this is where you start using your noodle, and any time period that you can choose here, if we go back into what we were working with, okay, which is the Fibonacci zones, you click on that, up comes the zones, and up comes your volatility, your matrix. And let's go back a little bit. So it's not something that we've been working with before. Any time on any of these days, pick any day, doesn't matter to me, your emphasis should be on the buying as opposed to the selling. Why? Because you're above the volatility direction. So if you decide to use this tool in combination with your zone analysis or Fibonacci zone trading, and you just click into a couple of other little tools, you can either go into systems with any tools that you like. You can define in the system. You don't have to redefine it every time. You go in there and you want to see the basic Gann swings with a high-low. Let's say you don't even want to see the basic Gann swings. Look, note as an example, look where the swing ends And believe me, it's random. It doesn't matter. I can go back and forth. It doesn't matter. Where does it really give you the V? It gives you the bottom of the V, a pivot here in the Fibonacci support band. Where does it give you the top? Fibonacci support resistance band at the top, so on and so forth. If you were looking to buy on this particular day with incorporating some of the tools, two things that stand out immediately. Let me just go back and have a look at the zones, how this is working. Okay. On this day here, which is the 17th of October, the close was in zone number 2. That was the final close. And then when we go to the next day, it opens in zone number 3. Something is wrong. Oh, no, it's correct. Excuse me, I was looking at the closing of this bar. Let me fatten up this bar a little bit. Okay. Price is opened at zone number 3. Okay? I can see that the open obviously is above the fulcrum. We don't know where this bar is going to be. So when the price is opened in zone number 3, we can look here, what is the information? We're going through the same routine that we went before. And what is the setup? The setup is, number one, we're looking at the direction of volatility direction, and we're nicely above it, and it is up. I have not even put on the daily high-low activator, but we can. But let's keep it simple. We saw here that the prices on the previous day was holding at the support band. Reasonable information. But when the price is open at a zone 2 close and a zone 3 open, by what we said, hey, of course, if it opens at zone 3, obviously going to be reached 100% of the time. But zone 4, we see it's reached 71% of the time. Okay? And zone number 2 is around 64% of the time. And that is the range that we're interested in to start with. Do I know that zone number 2 is going to be hit first, or zone number 4 is going to be hit first in spite of the fact that these are the highest numbers? No, sir, I don't know that. But I do know that if zone number 2 is reached, and it didn't get there in a reasonable fashion. In fact, zone number 2 was quite a few ticks away. Zone number 2 begins at 362, and the low of the bar was 363, so it was 1 cent away. Fine. How do I look at a situation like this when it doesn't reach it? It attempted to do it, and it didn't do it. But the support, and this is to me crucial information, the support there, if it would have reached it, was 73% of the time. Tremendous, very strong, useful support. In other words, it would only close lower than that zone 27% of the time. So it's like a 3-to-1 shot in my favor. Also, I look, next step is I look at what are the close probabilities. What it tells me that 57% of the time, the close is going to be higher than the open. Very nice. I look at the next day, again 57. Third, 56. Fourth, 58. Potential strong up market coming. Potential, capital P, folks. any signal that I would get to buy with, including closing above the high-low activator and the failing of this resistance band, that to me implicates a buy signal. What's the next thing? I can see that zone number 4 is reached 74% of the time, and the resistance is 64%. That's quite powerful. But what do I see on the close of the first bar? That the resistance, the potential resistance in zone number 4 is already failed. And zone number 5 resistance is lower than the one before. In other words, the backup is okay, but not great. And zone number 6, the resistance is very small. In other words, it's decreasing. And we know that zone number 6 is only reached 10% of the time. In other words, this is, in my book, an aberration bar. Something that is reached only 10% of the time, and it is reached, that means that whatever the reason, the market direction is definitely changing. And we had this before. So we go to the next one. Higher high, still in zone number 6. Higher high, still in zone number 6. Little retest to the downside. Momentarily we enter zone 5 here. But look at the high-low activator following up, the sell stop, keeping us honest. Hello? Beginning to look interesting. Has the high-low activator given a sell or a get-out sign? No. That's the next day, folks. So therefore, even though this was not what I call a wonderful, clear trade, it was muzzy. But we had sufficient information to go in the buy direction because of the support of the zone, which we never even reached. From a zonal analysis point of view, to me, a 57% chance of a higher close than the open is acceptable. This for me is definitely acceptable. But the most important thing here for me was we were above the directional volatility line. That tells me that if every time I trade in that direction, the chances of my having a favorable trade must improve. Would I have loaded the boat on this? The answer is no. Would I have taken the long trade? The answer is yes. Why didn't you load the boat, Kraus? I didn't load the boat because zone number 2 was not reached. If zone 2 would have been reached, which gives me 73% support, without a doubt I would have bought heavily into this market. Because if I was wrong, zone 2 is down here, and I would have been, look how near, look at this small distance, to the directional volatility line. This is the way I use it. These are the concepts, and unfortunately Sean is already run off to get his... Okay. This is the way that I use this particular concept. I think that of the private tools which I'm sharing with you today, this has the greatest implication, in my opinion, for your personal trading. If you're getting involved in either intraday trading and so on, if you put this on soybeans on the daily, weekly, it behaves exactly the same way. Let's just switch over to that for a split second. Window. Soybeans. Here is daily, weekly, January. January beans. And this now we have the weekly projected highs, projected lows. I don't think we'll have time to discuss the double time period concepts which are at the back of the book. But here you can, back of my book, not on the book that you have, because otherwise would have had to just print everything again. This is the weekly. This is the weekly Gann swing chart based on the weekly. The smaller ones in between are the daily. The real true guys who know and understand how to trade swing charts will know that this is the best place to sell, and in this vicinity is the best place to buy. Look at this weekly chart. What did we talk about? Rising valleys. Is this giving you a reasonable, even on weekly basis, an indication this low is higher than this low, price is taken upwards, nice little move, nothing to complain about. If we take these guys off, and if we go, I mean, I've already got it set in my system, use directional volatility. Now, on the soybeans on the daily, you should use the 1.618. Is it difficult to change? The answer is no. How can you eyeball it? You can see. Even in a sideways market, because from here to here it certainly was a sideways market, this is easy to trap. That's easy pickings. This is much more difficult. This is more difficult because these are sideways market. But even in a sideways market here, let's zoom in on this. You can see how the high-low activator tends to be on the correct side. This is not an easy trading area, by the way, because you had 3-4 days up, 1 day down. Massive slash down. Closes on the higher part of the day, still drops, bounces off, so on. This is not an easy 3 weeks, 4 weeks of trading. Nevertheless, if you said, okay, I know I'm in a trading range, I will only take trades for the moment above this particular directional indicator. Yes, you may have still had losing trades, but it should have been less because you were only trading or emphasizing the trades in the long direction. You didn't have too many trades. I can tell you that now without even putting up the rest, and we can easily put it up. But if you put up the Fibonacci zones of the weekly onto the daily, there are certain other pieces of information that starts coming through. Watch where the high-low activator, the directional line is apropos, because this is daily, weekly. So what you're watching here is a weekly line on the daily. And these are weekly support bands and weekly resistance bands, okay? Now when you're working with these lines, you can see that this was a reasonable buy. Here I would be looking to sell because there's no closes above the band. Comes back down again, tough. This I know was a losing trade from here to here because I would be looking to sell it. So for me, no discussion. This was a losing trade. But the moment it started climbing back above the volatility direction line, there is no way, it's impossible for me to be anything else but long on the close above this guy, on this day. So I just take my loss, thank you very much, and then the market was off to the races. So you had here 1, 2, 3, 4 very nice trading days, 3 trading days after this close. Let's go into the relatively simple tools. High-low activator on period. Let's show it. Hello? Did it keep you in the little trade after you went in here? This was a loss, okay? But when you got back in, followed you up, and if I just go bar by bar, you can see how two things happen. Number one, the high-low activator follows you up as a sell stop. But it stays far away enough not to make you look silly. Because if I put it in too tight, I could give you a calculation, and I know how to do it, and I have done it, that this is much tighter up here. If I base it on 2 days, of course, it'll always be closer up. And if I base it on 1.618 days, it'll be closer still. The range of the previous 2 days, so on and so forth. Wasn't that nice that we stayed with the high-low activator? Do you know what is the amount of money that goes from the low of this bar, just happens to be very nice, at 665 to the high of that bar, which is 707? We're talking big money. For the margin, this is huge money. Why is the trade succeeding? One reason only, folks. Besides, I know that I don't want to sound too facetious or smart aleck, but the main reason is that you're above the directional volatility line. Believe it or not. Because this looks at not just the prices, but the actual volatility apropos the direction. You start working with this tool. In the end, what happened to you, what happened to me? I almost can't trade without it. I look at, well, where's the line? Where's the line? Okay. Have a look downwards, folks. Let me make this line a little thicker. Did we have an isolated high here? Is this high higher than this guy, higher than this guy? Yes. Or do we have a V at the bottom here? Was this an indication that this may possibly be the high of the day? Yes. Little lower low. Hello. We closed below. Guess what? High-low activator, 45 daily basis. It's performing exactly the same way as if we were looking at the 45-minute wheat. Same concepts, same mathematical calculations, and the volatility you can see is either 1.382 or 1.618. Do I know which one to work with and everything? No, not everything, but you look at it for a couple of days, you will see yourself. And it's always threes. It doesn't change. It's always threes. It's not too difficult to get into this idea. Let's push it on a little further. Hello. There we are. Is the high-low activated daily basis following us down? Yes. Even if you sold it blind here, you knew immediately what your risk is. If it closes back above, we haven't even got the GAN swings on here. Closes back above the green line. Do I want to be long? Excuse me, short? No, not really. Hello. Look at the directional guy is starting to turn down. Closed back above. Either I broke even or I lost money. Do I mind? No, because I know that a good percentage of my trades are going to be losers. And that was the closing day Is there some kind somebody used the word divergence, so I will use it also. Is there something amiss here? Yes, guys, there is something amiss. Something is not quite right. Would you take this signal as a short to the downside? Yeah, you may want to do that. Would I take it? I would use other tools. Why? Because I'm above the directional volatility line. They're not in agreement.